Tack. Så, då börjar vi som vanligt på svenska för att övergå till engelska. Välkommen, hoppas lunchen var trevlig. Welcome back, I hope you enjoy your lunch. It is now time to start the end of this session, and we will have a keynote speaker, and that will be Matthew Dio. We had the pleasure of having you on stage yesterday, and then you spoke about Sigma Lithium. And this theme is the decarbonation of the supply line, electrical vehicles. Yeah. So without further ado, well, I should say this, that we will have at least one standing by with a mic. So after the presentation, there will be some Q&A. Just raise your hand, and I will direct my colleague with a mic, and you can ask your question.
So, yes, thank you. So I'm standing in for our CEO, Ana. She was called into government meetings with the Brazilian government for actually basically this topic. And I run business development and corporate functions, a number of them at Sigma. So this kind of works along with my day-to-day and some of the commercial strategy we have. But the thematic here is, how do you decarbonize the electric vehicle supply chain? I know a lot of you are familiar with electric vehicles, and Sigma in itself was started to align the lithium supply chain with the ethos of electric vehicles, right? We all like the idea of decarbonization and helping the environment, but there's ways to do it that are also carbon neutral, as opposed to what the current situation tends to push through. This is all within the broader challenge of the EU battery passport. In particular, building traceability into the supply chains. Right now, a vast majority of the lithium and critical battery metal supply chain runs through China. That's a problem geopolitically for everybody, but also that's a problem with traceability. Don't really know where it's coming from and the carbon footprint of it. And the EU in particular is at the leading edge of trying to build traceability and sustainability into the supply chain. And the industry is trying to work around that. But it's by no means just Europe. The US as well sees many significant and strategic merits to diversification of the supply chain away from the grip that China has. Now the challenge is how do you do this by also remaining low cost, low on waste. In the case of water, much of the existing supply chain happens in arid and semi-arid areas, and water and aquifer depletion is a problem. How you do it without significant chemical damage? Can you do it with clean power? Some of our peers in Australia mine lithium and run their plants off of diesel generators. Again, kind of fights back against the ethos of where we're trying to go here. In China, the chemical synthesis here works, the front end of it, with a big calcine oven. What are you firing that oven with? Oftentimes it can be coal, but it doesn't have to be. And then labor. What are your labor standards, right? One of the big things that we saw with the boom of lithium over the past 2 years is a fractionation of the supply line, and in many cases, artisanal mining in jurisdictions like Africa that bring death amongst labor, child labor, issues along the lines. So this is generally a good portion of the supply line. That's about where the market is right now. The blue represents sources of lithium from traceable, sustainable, maybe not even sustainable, but traceable, minimum, work ethic regions. The red represents basically Africa and high-cost supply from China. So we have in this market a shortfall of product that would meet what we consider to be global standards, particularly those in line with electric vehicles. The problem is, again, how do you do it low cost? And oftentimes low cost means a race to the bottom, particularly in ethical standards. We've seen this in cobalt, for example. And the problem is the growth rates associated with this industry create shortfalls that have to be addressed quickly. And oftentimes those are corners cut, and that's problematic. Again, lithium is not scarce. It's critical. Getting it out of the ground fast enough is the issue. And we're dealing with an industry that even this year, where we hear a lot about slower electric vehicle sales in the US and Europe, still growing 20 to 25%. We're going to need 5 or 6 new Sigmas every year to come to market to fill that. So, shameless plug time. Talking about Sigma, we are the 5th largest hard rock mining company for lithium in the world. We're the 10th largest lithium producer. This is kind of just an overview of our site. What makes Sigma unique is we deliver a source of lithium that is zero carbon, has zero tailings dams, uses zero potable water, recycles all of our water, uses clean energy as our base form of electricity, no chemicals. A lot of that's possible through our geology and our processing technology, but at the top of the screen you have our crushing circuit. On the right is our primary beneficiation complex, water recirculation filtration, and our tailings dry stacker on the right. This is it during the day. We're in the process of doubling our capacity. The Brazilian government just gave us a 16-year loan, or 16-year debt at 2.5% interest rates. Very attractive paper. We're basically rebuilding this yellow block here where the red is to double our production. As I kind of talked a little bit about the trinity of low cost and sustainability, I'll try to move quickly through this a little bit, but the whole point is mining doesn't have to be a dirty, unsustainable industry. It has for a long time because the demand wasn't there for anything different. Critical elements, resources, gold, etc. The onus hasn't been put on companies to operate as well as they can or to think outside of the box. In many cases, people go to regions, they deploy existing technologies. The thought process about being innovative hasn't really been there, but it's possible. We have the technology to do this. Sigma is doing it in a way that is not really, it's all out-of-the-box solutions. We adapted technology from diamond mining, so we don't have flotation, which means we don't have tailings dams, which means we don't have flotation chemicals. It's all possible. It's just a question of doing the pilot work and getting there. Sigma was a bit of an innovator in this regard, but we didn't do anything that requires significant excessive technology because you don't want to. Everything should be off the shelf because if it breaks, it should be cheap to repair it. We benefit in Brazil. 90% of the grid is clean energy, either solar, hydro, wind, or nuclear. So decarbonization in some respects becomes pretty easy because a lot of the industrial complex is electrification. That's all clean. Where we have carbon, mining. But we're experiencing and generating new technologies, right? In Brazil, we benefit from biodiesel. But Libra, Cat, they're all coming out with electric mine trucks now too. If you can hook that to a grid that's clean, we have what we're experiencing or what we're exposed to is only 0.27 kilograms of CO2 per ton of concentrate we produce. It's really actually not hard to decarbonize these mining situations. And with that, to go full net zero carbon, we're only spending $750,000 a year. It's $3.60 per ton of product we sell. So it's the display here, the point here is, we benefit a lot from Brazil, but it isn't difficult to do this. It's just different. As for us, we call it the River of Poo, Schitt's Creek, however you want to call it. We pull water from a non-potable stream. It gets processed, so no consumable waters. Water's recirculated, so we reduce our pull on that. Dry stacking also allows us to sell our tailings over time or upgrade them. So we come, when the market conditions allow, we have a zero tailings process. We donate, as you'll see, we donate our gravel for roads. We can reprocess it, anything above 1%, and the rest gets made into blocks that we donate for infrastructure around our community. Tailings dry stacking preserves the value of the lithium because any lithium lost in our tailings process can be reprocessed. Also, there's no cost with the tailing dam or ongoing environmental liability and allows for a more sustainable remediation process. But here's the general frame. I'll be done with my shameless plug on Sigma in a minute, but this is the terms of the Brazilian government debt. What Brazil in general has done, and this goes into the ethos of the whole discussion here, is how do you deliver a product to the market that's clean and sustainable, but also cost efficient? And one of the big problems we've seen with the industry is trying to re-industrialize geographies which have de-industrialized over time. So you have to provide a supply chain through emerging markets. It's really the only way that's going to compete with China over time. Governments are now stepping in, and Brazil in particular is stepping in a big way because they realize this. The goal here is to allow for decarbonization of supply chains and to do so at highly attractive costs. And the Brazilian government is now putting the National Development Bank behind it. It's very calculated. They gave a $100 million loan to VW. They gave a $100 million loan to BYD. China, the West, gave us $100 million to help supply it. As long as you're in the industrial process, it's almost China in some respects, the government is there to support you. And we have, at the moment, perhaps one of the more progressive governments Brazil has had, and here they are stepping into industry in a big way to help support growth. This level of government intervention needs to happen to help lower cost of capital to enable this energy transition. We're seeing it in other regions as well. Canada is doing it, Australia is doing it. The U.S., God bless, we're trying, but it's there's a lot of it's hard to spend government money. It's both easy and difficult to spend government money in the U.S. and depending on where you fall. And right now, we're probably not deploying it as fast as we need to be. But governments in general are showing the desire and the need to step up. They're also showing that there is an appetite to diversify the supply chains away from China, and I can talk a little bit about that. But the challenge here is how do you diversify from China in a way that doesn't sacrifice costs? So here is a general footprint of the tons of CO2 per ton of lithium chemical, depending on the source. And this is obviously a huge issue with the buyer and the whole dynamics of electric vehicles. If you buy an electric vehicle, it's because you want to decarbonize, you don't want to know that for every ton of chemical, there were 45 tons of carbon. And when I talked about the fact that demand grew very fast and supply bifurcated and new sources came in, on the left here you have lepidolite, which is a very low-grade lithium material in China. China has been a very big step function into the supply chain. A lot of that is lepidolite. This stuff is an environmental catastrophe. For every ton of chemical or lithium you dig out of the ground, you have to move 150 to 200 tons of rock. This is basically digging up your backyard to get a ton of chemical. But it's a source of supply in a market that needed it. Unfortunately, processing all of that creates carbon. Spodumene, this is what you consider or what we sell, lithium concentrate. Depending on the way that it's converted, can deliver between 13 to 15 tons. And again, a big part of that is some of our peers in Australia run their plants off diesel generators. Problematic. Brine, this is probably perhaps what you're most familiar with. Chile, Argentina, the big solar evaporation ponds. The sun does a lot of the work for it. For concentrating that brine, in the end, creates a very attractive carbon footprint, 5 tons. DLE, direct lithium extraction, this is without using the big solar evaporation ponds and actually pulling lithium directly out of the brine immediately, can be even lower. Sigma, and I'm using Sigma here because we're the first in Brazil, but there will be more of us. If we use best-in-class China, i.e. if that big furnace that I talked about is fired with electricity or gas as opposed to coal like the 13 to 15, we can get you down to 2.5. In average, the average conversion plant, we come out at 5. This is the goal, a situation that creates a much better environmental footprint. The problem here is, and this isn't just me, this is everybody now talking. I'll give you a couple slides around headlines just to paint the global picture and what we're dealing with, right? So here's the backdrop. China's monopoly on processed lithium, and China controls 80% of global lithium chemical production, right? Despite having less than 7% of reserves. China doesn't have the material itself to supply themselves, but they have built the chemical capacity in 2019 and 2020 when the industry was down to process all of it. However, we have now way too much processing technology. It's created a problem because companies want to invest outside of China for this, but the average utilization rate, this says 40% last year. It's probably closer to 60 now. But nobody really wants to invest in an industry that's got 60% utilization rates. It's not attractive for returns. But we wrestle with this situation where so much of us depends on China. The other side of that, beyond just how should I say this? The carbon, well, I should say, at one end we have the carbon problem of China. On the other hand, they're actually really good at processing it. And there's a few different reasons, but primarily it's because two reasons. One, think about this. We ship a product that's 5.5% lithium to China to get processed. That means 94.5% what we sell is just waste rock. What happens? It goes into a big furnace, it roasts, then you put sulfuric acid on it to create lithium sulfate. From there, lithium sulfate gets moved into lithium chemicals. Okay, fine, easy enough. Well, that 94.5% lithium or sulfuric acid tainted waste rock is a bit of a problem. You can't really remediate it that well, but you can drop it into the cement industry. In China, that goes into concrete and cement binding. It can work in China because China is an EM economy that is heavy concrete and cement based built. Also in China, big cleaning industry, a lot of people, some of that byproduct moves into cleaning supplies. So there isn't really any waste at the end of the day for this network within China, but it does create problems when you think about where else you can build this stuff. Europe, for example, you have a big oven, what are you going to fire that oven with? German coal? Not so much, right? Gas? No offense, you tell me the gas price. It's $100, it's $5, nothing is as competitive as Saudi or the US. And then where are you going to put the waste? It's really steel and glass infrastructure now. So how do you deal with this? At the same time, you have this end, but then you have the environmental concerns of the mining and resource side in China. As I said, some of that lepidolite, you're processing 150 to 200 tons of earth. That's not the processable stuff, that's just waste movement. And if you don't process that correctly, it ends up in river systems and we have shutdowns. So the supply chain is often also incredibly volatile because you have situations where China will shut down regions that are not environmentally sound quickly because you can't have river pollution. It creates a lot of volatility. And as I said, oversupply also in the utilization of these assets creates really difficult situations. So the industry is rethinking its strategy. We've had companies try to build these plants outside of China. The problem is it gets super expensive, and I'll talk about numbers. And I don't like bashing my peers. This is not the intent. It's really hard. These are all very capable companies. The problem is we're stepping out into regions and moving into dollar CapEx without a really comprehensive plan. Piedmont, one of our peers, is abandoning a $600 million plant they had in Tennessee. Albemarle is slowing its halting expansion. Albemarle was canceling a $1 billion plant in Richburg in the U.S. Lithium Americas is raising its CapEx budgets and issuing stock, and Albemarle is issuing stock. And Tianqi, a Chinese company, is slowing plans in Western Australia. We came out as an industry with these really grandiose plans to move past China, and what happened is the cycle got oversupplied, and now all of a sudden you have billions wasted, equity recaps, and a lot of carnage. And as I mentioned, oversupply. So this is just the margin profile of buying what we sell, this concentrate, and trying to make chemicals. For a period of time, it was very profitable, but in reality, over time, it's not. And in this year, margins were like firmly negative for a good period of time. And over time, they've been close to zero. So it's not and even look, this is a good period of profitability, but that amount of volatility isn't conducive to making investments. It really isn't. You'd love a steady return over time. Obviously, everybody would, but this is a very difficult backdrop to invest in. And so at the moment, no region can offer what China does, and that's the problem. As I said, well, over 60% dependent. China has over 30 companies capable of making battery-grade lithium from this rock. There's 5 plants in the rest of the world, and they're getting tabled. In 2018, there were only 5 companies that could do it. China has proliferated this technology dramatically. And I'll say one thing. We call this specialty chemicals, but anywhere where China has proliferated technology is not really specialty anymore. That said, structural cost advantages, $10,000 to $15,000 per ton of CapEx versus $25,000 to $30,000 a ton in developed markets. As we said, low operating expenses, technical expertise, ample waste upcycling opportunities, and the largest market of consumption. The problems, again, geopolitical, tensions are mounting, customers want traceability, And demand is there now for lower carbon solutions. We see that. European automakers are coming to us now saying we need a better option. The other side of that as well is the supply chain is very inefficient. We ship 5.5% lithium from Brazil to China. It's a long way to go for a lot of waste. You're shipping a lot of waste. It's an environmental footprint for that waste. It's a cost on that waste. But look, Australia is the market where we've tried to do this. High CapEx, high operating costs, limited waste upcycling, but it's close to resource, which is good. United States, high CapEx, limited resource proximity. You're still shipping a lot, but we do have lower energy costs and we do have a technical expertise, so you get a little bit here. In Europe, high CapEx, high OpEx, no waste solution. You do have technical expertise here for chemicals, which is great, and it's a market for consumption, which is also good. Africa, high operating costs, limited waste solution, limited technical expertise, but you can build very inexpensively there. The whole of this, I say Brazil gets you close. There are other geographies that are looking at this. Think Saudi Arabia in some respects, or Dubai. Think also Morocco. Low CapEx, low OpEx, ample waste solutions, proximity to resource, but a little bit on the limited technical expertise side of this. So no real solution is holistically as responsible or attractive as China. But what works here is we can actually bifurcate the supply chain. And this is, I think, we're seeing now on a bigger level, and this is how we can decarbonize, is a focus on breaking down this process further. So in regions like Brazil, you can put that big furnace and wash next to your mine, and you can then ship a lithium sulfate, a lithium intermediates product. That way, what happens is you're moving something that's 30% lithium now. So you've cut down on the waste. And then you can just build a downstream specialty plant at site for demand. You're talking about batch processing, chemical engineering, things Europe does very well, things the US does very well. You still deliver on localization, and now you can do it green. And this also maximizes basically the competitive strengths of the global supply chain. You have a traceable, capital cost efficient, waste efficient, and green supply chain. And it introduces diversification to existing supply chain while neutralizing some of the geopolitical risk. And look, the demand is coming. This is updated for more bearish situations, but this is the European gigafactory capacity. There will be more demand locally for consumption in Europe that we have to basically hit. And traceability is the key issue. So this is just generally a flow sheet. This is kind of where we are. And when I say we, I mean the whole industry. Mining, crushing and upgrading waste, sell spodumene concentrate, this big calcine, roasting, calcination, crystallization. The key is incremental investment to move downstream while not spending the billions of dollars ourselves and maximizing what we know our value assertion can take us. And that keeps us from diluting our competitive strengths into this territory, which we're not good at. At the same time, you can get a better return because European companies are not having to invest in this capital-intensive, emerging market-centric part of the actual supply chain. What will we eventually need that doesn't exist, that will be helpful? The more demand that you get from auto companies for this green product will build in some form of traceability premium. And I don't have the slide, we have another one, but you're already seeing the market bifurcate a little bit. You can price this lithium from Zimbabwe, you can price it from Brazil, and you can price it from Australia, US. You're starting to see prices diverge a bit, with Africa containing this lower premium, this lower price, as demand pull is starting to request some traceability. It's not huge yet, but directionally it's where we're going. This is basically the same thing on a higher scale basis. But look, this, you don't even need to worry about this. Don't even worry about this. That's, at the end of the day, like, these are just to show the average margin structure of a chemical plant. We have what we consider to be a superior product at Sigma. We can create a ton of chemical more efficiently than our peers can with their product. So we can kind of extract, we deliver more value to our customer. When we go downstream, we can extract that value, which is part of our reason why we would do this. We think there's margin for us, but this isn't supposed to be about Sigma. This is generally kind of an industry conversation. But that's, when we talk with customers and when we engage with governments, the big question is, how do we diversify from China, and how can we do this? And I think this is the solution we're increasingly pushing as a company, and this is the solution that's gaining traction. And the Brazilian government, for example, through the National Development Bank, and again, it's not just us. Pilbara, one of our peers in Australia, just bought our neighbor in Brazil, Latin Resources. We've had conversations with them. They view this again as a similar way, and the Brazilian government will step in to help, particularly when it gets to decarbonization. So that's, in our view, how the industry moves out of this current kind of rut, or the stalemate that we're in. And that, I'll stop there. I don't know if anybody have any questions or not, but that's the presentation.
Thank you for that, Matthew. So we open up the floor for questions, and you raise your hand, and Monier will be there in a second. I have one question here, because sure. Now you've shown us the path, so to speak. Mm-hmm. Could you give us a time frame if, let's say, all ducks in a row, the stars are aligned, how many years will it take for us to be there? And I'm connecting that question because I believe that the year 2050 is an important year.
Yeah. No, we can do it a lot faster than that. Look, the demand pull has to be there. We're not going to spend a significant amount of money ahead of to develop this. Now, we already have some European companies that are looking at building inbound for lithium sulfate. China can take it. So there's a supply chain that's growing around this, and that's the thing. It has to develop a little bit at once. We are focusing on expanding our resource. Through that, we can integrate into this intermediates platform if we so choose. It's hard to say, but like, so, you know, one of our peers is investing $1.5 billion to build this facility out in Australia. Now that's the full complex, but we can put a calcine and an acid wash for $200 million in Brazil. And that's a vast majority of that massive spend. So capital efficiently, we can do it quite quick and quickly. It's a calcine and a sulfuric acid station. We can build that in a year and a half. So when we talk internally about this at Sigma, we're talking 2027. So, and I mean, it's not, if we wanted to, we could do that faster. Mm-hmm. We don't necessarily want to at the moment, but this is, you know, 2 years away type situation, not 10, 15 years away.
So the crux here is not really time. We have the technology. We just need to put the money where the mouth.
Yeah, it's getting the ducks in a row. Uh-huh. You know, building the supply chain around it. And in Europe and in the U.S., we've had a little bit of a slowdown in this energy transition or electric vehicle transition, and this gives the industry in general a sense to collectively catch our breaths. We've been sprinting for 2.5 years. Mm-hmm. It's a good time to take stock of where you are and reassess the situation. This is healthy in the grand scheme of things for making sure that the industry adjusts in a way that is the best for everybody and the one that is the most economically viable. If prices stay really high for a really long time, you're going to be met with a lot of solutions that don't make sense. In the grand scheme of things, the goal is to keep costs low because we want adoption up. And that will be helpful, particularly when you think of European automakers who are trying to fight against this wave of Chinese electric vehicles, which are really cheap. Like, I don't know, we don't have Zeekr in the US, but I walked by the dealership last night. It's a nice car, its specs are phenomenal. It's not that expensive, particularly when you think about what you're getting. So doing it in a framework that delivers on the ethos of it, but also cost efficiently and without putting European or US business out of business.
So the answer there also is really it has to be some economics behind it.
Yeah.
Any questions from the floor? And I'll continue there. And
how do you think that the situation of Northvolt will affect the industry of lithium? I'll take it again with the microphone. How do you think that the situation of Northvolt Industries?
Yeah, look, we invested where we did because, from our view, over the life of our project or over our investable horizon as a company, the best decision is to own the lithium. Battery making is a tough business, and it is not a panacea, and the technology changes all the time. And we, hear from the Brazilian government, we should invest in batteries. No, it's tough. Technology changes, costs are high. You need to be able to do this cost and capital efficiently. A lot of companies will make it, a lot of them won't. This kind of goes into this view of, unfortunately, in a market, trying to figure out the way to do things as cost and capital efficiently as possible. And sometimes the situation will get tough for certain players. That's
Right, we will thank you for that. Yeah, okay. We're running out of time, but be quick.
sure.
I arrived a little bit late, so maybe you might have already addressed this. So in that case, you can forgo this question. But what about alternatives to lithium? Because
Sure.
there's magnesium, iodine, sodium, iron, zinc, air batteries.
Yeah. For a number of those, the problem is weight and cycle time. Sodium is a little bit unique in this argument, but some of them, the problem with batteries mass density, you get to a point where you're adding more weight to move the weight. And that becomes a problem for electric vehicles and certain technologies as you start adding battery just to move the battery. Lithium being the lightest metal and the fastest from a cycle time perspective creates the best performance. Energy storage, perfect application for a lot of these batteries. Sodium is a little unique because sodium still delivers, at least if you believe some of the specs from CATL, they can put together a battery that's decently competitive. You heard a lot about that in 2022 when the price of lithium was $40,000 a ton and above. The price of lithium is now $10,000. So you don't hear that as much. I think in a world, and what we as an industry have to remember is we don't sell lithium to industrial companies. In China, these are tech companies. They're highly innovative. What we had heard in the general conversation was the idea of a sodium-ion battery car is pretty low risk. What you might see in a world that develops over time is if you have an electric vehicle, this big lithium-ion battery powers the car, but all the drivetrain, but also your AC, your audio, your windows, your cameras. Maybe you start in a world where you have a small sodium-ion battery that runs that, and the performance of the vehicle runs on lithium. And over time, you have a creep in the cell structure. But even then, in a world where electric vehicles are growing and rapidly growing, particularly in China, you still have a demand picture that requires a lot of lithium. But yes, no, particularly when prices are high, this is substitution conversation comes in. And whether that's just talk from CATL to lower the price or that's real, we sell to tech companies. There's make no mistakes. The worst thing for an industry is high prices that are too high. Look, these are all risks in operating a business at all times, but lithium supply chain and the technology and the advancements behind lithium batteries are such that this will be the future for the next 10 plus years. And the amount of growth we're at this 1 million ton market right now. Even bearish suggestions are 2.8 million tons of demand by 2030, going to 5. So we still need so much new supply and investment that it creates topics of conversation, but it's not necessarily detracts from the overall profile of ultimately where we're going. Of course.
And thank you.
Yep.
So we'll give you a round of applause. Thank you.
Thank you.
And we will now welcome two speakers here. We'll have a panel debate. And there will be John Fennick from the John Fennick Consulting Group, based on demand from commodity companies, especially those in the metals and mining sector. Fennick Consulting Group helps small and mid-cap companies to raise awareness of their brand. And John Fennick, also the founder of the Fennick Commodities Report. So please enter the stage. And he will be joined by Erik Strand. And as we know from yesterday's presentation, he's the founder and manager of the successful AG Fond, specializing in creating value via investment in commodities. And the theme here will be, is patience really a virtue when you invest? I will kick off with a couple of questions. And as in the previous meeting, you are able to raise your hand and ask questions. And this time, don't be shy. Lift your arm, and you will get the opportunity. John and Eric, it's a pleasure to have you here, both on stage.
Thank you.
As I said, patience is that really a virtue. You invest, you advise, and you both know, let's say, the industry from the investor's side, which I think is interesting because now we have heard a lot from the supplier's side, and those with the feet on the ground don't necessarily know all the comings and goings when it comes to the equity market. So, Eric, how long is your patience with a holding that doesn't develop in the way that you have expected?
Well, actually, we like to invest with a style like we invest forever. So we are rather patient, I would say, and because we believe in the companies. But of course, we have some candidates to put into the portfolio instead of the company. But we have a lot of trust, and we have a lot of communication with the companies whenever they have some problems. But we do understand the markets, and it's not very easy for the companies. So we have a lot of respect for that.
And you mentioned yesterday you had 4 criteria. If you could just remind us on when you look, it's jurisdiction.
It's jurisdiction. It's of course the portfolio, or if they, how much gold or silver or lithium or copper they have, and for us also the liquidity of the stocks, because we have to be able to buy, but especially to sell. And then the management is very important for us. And the 5th thing that we didn't mention is the sustainability. And we don't think that the ESG is gone. We think it is very important, and we are mining better than ever. And we will mine, I hope, even better in the future. And it's our job to put some pressure on this. And I think when we have the discussions with the companies about this, they will always get more institutional investors. And if they get more institutional investors into the company, the equity price will go up, and it's good for the company, it's good for us. So we have a good dialogue around ESG as well.
It pays to be good. And John, if I turn to you, and you're in a role with your hat on as a corporate advisor to a small or mid-cap company, what is the, let's say, 3 most important things when a company is going public? What do you want them to understand about the market?
We don't really work with pre-IPO or close to IPO situations. We're going to be investing in companies that have been around for a while, but I think there's just room for improvement in general. You know, I've been a professional musician since I was 13, and I always learn all the time about music. So it's the same with investing. You continually grow and learn. And as a company, I think you just need to be open-minded to that. When I talk to CEOs a lot in this sector, they're like, hey, I need to get all of my money in the ground, and they miss the entire marketing piece completely. And I think there needs to be a balance. And so we try to work with companies in that regard of striking that balance. While the majority of the money should go in the ground, you also have to get your story out there, and it has to be in a certain way, right? I see so many websites with misspelled words, fact sheets that are outdated, you know, putting the share structure all the way in the back instead of in the front, where, you know, someone like Eric and I want to see that right away. These are just little things that I help with on the deck and the presentation to a high net worth client, because they're seeing this, and if they see these kind of things, they'll get back to me and say, why did you recommend this? Because it looks sloppy, right? And so like these are little things that I think are important. And we're holding a conference next month in Florida in October at the Four Seasons Fort Lauderdale, and I've really tried to bring companies that, you know, share this kind of mindset, that they're willing to interact with clients to get to build relationships, because I think that's important. You know, building the relationships with clients is so important, because you don't want to, as a junior, mid-tier, or producing company, you don't want to rebuild your capital structure, right? That's something that I see happening a lot, where companies are forced to rebuild this through bad decision making, poor luck. I mean, sometimes it is just luck, you know, that you had bad timing, right? You have a great deposit, but the silver price was depressed, and you're all-in sustaining cost was 25 an ounce, and silver was under 25 at the time, but now it's at 32, and the timing of things really matter, and so it's not just management's fault. It's a combination of things. So, long answer to say that we try to work with people on their messaging and also to help get their story out there through conferences like this and through podcast, TV, radio, Kitco, et cetera.
And I noticed there when you're talking about long relations, and then you would say that you have your investments, well, not forever, but forever. That's the assumption here. So that is, it sounds like, let's say, a plan, but it's easier said than done, I take it. Now, how do you approach companies that you like, but maybe you would like them to, let's say, communicate in a better way? Or do you approach them with that?
Well, first of all, I think that is something that a lot of companies are missing is the communication and the story and how they do it. But I also see some companies are starting to do it really good. But mining has a rather bad average on communication.
Okay.
So I think they can win a lot on just getting good at how to communicate. And I think maybe they communicate sometimes too much about the grades and everything, what is in the ground. I mean, it's important, but anyway, in the end, you have to believe the numbers or what you see, and it doesn't really matter, but it's how you tell the story, and I think that's missing, and how you communicate. But I think we also see some good examples, and I think the rest will follow.
And as we do have a mix of, let's say, professionals, institutionals, retails, would you suggest that a mining company will, let's say, cater to different investors, or should it be, let's say, the same format, albeit a good format rather than a sloppy one? Should there be a difference in the communication?
Absolutely. The retail investor is not a geologist.
No.
We need to understand that. I'm not a geologist, and this is what I do for a living. So when people are talking, they need to understand a little bit more about their audience, I think. And I really appreciate it in events like this when someone's trying to get to know me, because my previous job was doing that. I was working with private equity, hedge funds, big portfolio managers in the US, and I'd have 1 to 5 minutes to get my point across. That's it. And that's one of the things I work with CEOs on is their messaging. I think Ashley Berry, who's here, a bunch of you guys know, does a great job of that too. She coaches people in this regard. It's important to have your deck, absolutely, but then you have to have a 15-minute or 10-minute pitch, and you have to have your elevator pitch down. And the elevator pitch is what I find most CEOs struggle with. How can you get your message across in 60 to 120 seconds? And that's important.
And if I turn to you then, Eric, I mean, obviously you don't need to indulge all the tools of the trade here and secrets, but I mean, over a year, how many companies do you, let's say, evaluate? And the reason behind that question is how obviously you being a professional, but let's say you evaluate a number of companies, you will not, I guess, go into depth until you find it interesting. And in that case, what makes it interesting? That's the genius behind that question, if there is a genius.
Well, actually, I think we have almost a slightly different problem, and that is that we have too few companies.
Okay.
Because we have all these mergers and acquisitions. Right. And that's a problem for me, because I want the universe to be there. And I think when we screen down the universe, we don't have so much left to choose from. So I actually have the opposite problem. And
Interesting.
And probably we see more mergers and acquisitions, so that problem will get bigger. And I hope we get more new companies getting up, so we have more to choose from, because that's the problem. So we have the portfolio, then we like to have 5, 6 candidates that we would like to put in the portfolio, but we have to see they have to be better than something we already have. Right. So that's how we do it. So we have 25 in the portfolio, 5 candidates, but they have to prove, or we have to think that they are better than one existing.
Yesterday you mentioned one thing, if I'm not recollecting in a wrong way here, that you thought that the majors were perhaps looking at companies that were very close to produce rather than, let's say, juniors that were exploring. And the bottom line is that we need more of the commodities. And in that case, you will have to watch and do a lot of work of companies with a smaller market cap. So how do you square the circle?
Well, I don't see it as a problem. I just see it as a different. It's different this time. 2011, when the gold price was really high, they did a lot of spending, explorations on their own. They don't do that. They buy producing companies, mid cap. The mega caps buys the mid cap or large cap even, and that doesn't produce more gold, silver, or copper.
Right.
So the process that the smaller companies will get the money, it will take some more time this time around, and I think that's different. So it takes more time. They have to need to go through this difficult period they have as explorers or developers. They don't have the money, but when it comes, I think the returns in that market will be explosive.
Yes.
And if we look at the market here, we can clearly see that the juniors have been lagging, obviously, the majors and also the underlying price. What do you think are the main reasons for this? If you could just give us 3 main reasons in a world with a million reasons.
Well, pointing out at something that probably everyone in the room is aware of, there's never been a disparity like this in history where the gold price is this high and gold explorers, developers in particular, are this low in price. So that gap is going to narrow. I would argue that the explorers and developers are going to do great things over the next 12 to 24 months, and that everyone sitting in this room should go back to their computer when the market opens up today and buy some gold stocks. Seriously. You also want to be buying some silver stocks as well. Silver, hopefully we can get to. If not, I worked on the silver team at Sprott for 2 years. I have a lot of my number one position is physical silver. And yet every time I was interviewed last year, I said silver will not break 26, and here's why. So I try to be pragmatic with clients and listeners like yourselves, because that's, we just talked about building relationships. I want to build relationships with my clients and with you, and be here for the long haul, as opposed to just be talking $80 to $100 silver like so many people I see online, and we've never hit that price ever in history. So it's not something that's helpful to the client base, right? So I feel like the junior market right now is just completely mispriced. I see some people here in the audience that represent some of these companies. Do you mind if I just mention a few
I don't mind.
names? So Tero, I see you first. Tero Kosonen with NewQuest. They oversee a few different companies in the portfolio. One is one that we invest in called Inflection Resources, which is AUCUF in the States and AUCU in Canada. It's an 11-cent US stock right now. They're in New South Wales, which is a great jurisdiction in Australia. If you take some time to look at their deck and look at the board, it's a deep bench of people, and they have a partnership with Anglo. So at 11 cents, what's the risk? Sure, there's risk in everything, but the company is getting most of their drilling funded by Anglo. So it's like seeing this kind of an opportunity every single day with gold doing this, making higher lows, and the stock is literally trading like this. At some point that gap narrows, and you want to be buying that now, because it could be up 40 to 80%, I think, this year by accident. Going from 11 cents to 18 cents or something is completely within the realm of that chart. So those are the kind of opportunities we look for as value managers.
Do we have any?
May I add
Yeah,
something to that?
absolutely.
I think that's because yesterday I spoke. I would like to see miners become price makers and not price takers, as they are. And actually, also, what I think about the exploration companies, I think actually it's a small mistake that they have so low share prices. Because I understand the idea when you have very low and people buy it up to $1 and the returns look amazing, but actually, they are getting that a little bit in the scamming. It's and actually, our custodian and the banks, they don't want us to trade stocks below $1 because these companies, they are scamming in this area below $1, and then they don't. Even if our company would be good, if it's priced at 20 cents, it's not okay for them because they see it as a risk. even if maybe that company is not a risk. So I would like to see them to get over $1 so I can trade the companies.
That's a great point.
Yeah. So yeah, basically, you guys need to do a reverse split.
Yeah, yeah. I
Yeah,
actually,
no.
I actually want them to do that.
I agree. I mean, there is a point when you need to do a split, and there is a point when you need to do a reverse split. Any questions from the? There we have one. So you have the mic now.
Question. 1, 2, 3. Question for John Fennick. John, we probably lived, at least in my lifetime, the worst ever situation for this space over the past almost 10 years. What is your vision? What is your feel? What is your what does your experience dictates going forward?
Mhm.
Speaking of patience as a virtue.
Yes, that was a timely statement. So looking at producers like an Agnico right now, AEM, beautiful looking chart, right? I mean, like they're doing everything right. Look at their earnings over the last, 3 quarters. They're putting up numbers, and that stock is getting some love. But many of the producers still haven't caught up. It's crazy. When you look at the developers and the explorers, they are usually, the next 2 groups to catch fire, and they haven't yet really. So that's what we're saying as value managers, is that the opportunity now is insane. Like we rarely used words like insane or anything inflammatory, but right now the disconnect is just huge. In my opinion, the reason this disconnect exists is because the average investor that's in the broad market with their serious money is chasing stuff, right? There's a lot of chasing going on in momentum stocks like NVIDIA, you name your favorite tech stock. Look at the S&P 500. I mean, literally over 35% in the top 10 holdings are tech stocks. It's crazy. We've never seen that kind of an overweight in the S&P ever, ever, ever. The last time this happened was 2008, and look at how that ended for those overweight the S&P, right? So I constantly, in my newsletter, put out to people, hey, if you have serious money, you need to meet with your financial advisor, take some money off the table in the broad market, and deploy it into a sector like this that's completely unloved and misunderstood.
Any reflections there? I mean,
No, it's the perfect description of the market,
Yeah.
and we see all these difficulties with this global index
Mm.
buying the same companies more and more,
Right.
especially the U.S. companies.
Mhm.
So I think we will have a short circuit breakdown of the index management one day, and it will be painful for the investors having all their money there.
And for those of you that don't believe Eric and I, just look at the news last month in Japan.
Okay.
Does anyone remember what happened? Nikkei down 12.4% one day.
One day, yeah.
That is not a small index. Yeah, if that happened in the U.S., that would be mass hysteria.
Yeah, I think it could be worthwhile highlighting that the professional investor will obviously have a correlation between one sector and another. So you can have a negative correlation between, let's say, metals and minings and tech, which means that if you're overweight tech, you need to be underweight another sector. And obviously, that has to change in a way.
Can we talk about that for a sec? Because I think Eric
Yeah.
and I can help the audience.
Yeah.
When you look at the S&P, the NASDAQ, the Russell 2000, and the Dow, how many gold and silver stocks do you see in there? It's ridiculously low.
Yeah.
It's under 25, I would say, if you really, I mean, Newmont is the only one that comes to mind in the S&P, NEM. So think about how under-owned our sector is. That's the real opportunity. When you start getting real money coming in on the generalist side into our sector, which I think we're on the precipice of. Look at, do you guys know GDX, the big ETF out there run by VanEck? It's a big ETF in the States that will have some of the larger cap producers in it. Look at the top 3 holdings. It's Agnico, it's Newmont, 2 that I mentioned, and Barrick, which is symbol GOLD, right? That represents 1/3 almost of the entire ETF. And these companies in January, April, and July have all put up really good quarters. I mean, very quietly, because the market, the broad market is continuing to do this since March of 2009, right? So it's a huge distraction. I think we need to see a correction in the broad market to really bring in people into our sector on the equity side, to answer your question earlier, and that's around the corner. We have so much going on right now. I mean, being a U.S. citizen, look at what's happened with Trump 2 different people in the last, 3 months, like, have tried to kill him. I mean, it's like, that in itself is a whole nother discussion, but November 5th is the election, right? There's gonna be a lot of uncertainty coming up between now and the election, in my opinion, and I think people that are just playing with their money like it's a casino are gonna get hurt, and they need to think about, you know, real cash flow that's being generated by the names I just mentioned. Go take a look at the numbers. I mean, the numbers don't lie. There's a lot of opportunity in our sector.
Eric, any comments?
Yeah, I would say it's like another perfect storm here. I mean, with the mining sector having this tough 10 years or whatever, and then you have the equity market, bond market going up so much in value, and when you get that, the flows changing, this big money chasing a small sector, I mean, big things will happen.
Yeah.
Yeah, interesting. So there will be obviously an underlying demand for the commodity, particularly precious metals, and the instrument, the equity, the stock in itself is undervalued due to technical reasons, and perhaps some, let's say, one could sharpen up the communications in a way, and if we add into that a reverse split, then there we have it. Well, thank you, gentlemen. It was an honor and a pleasure. I think we should give them an applause.
Thank you.
Thank you.
Thank you so much.
Of course.
Thank you.
Thank you.
And now it's time to introduce our next speaker. So we will have Kootenay Silver in the building. Ah, there. So James McDonald, I take it? Yes. Welcome. Kootenay Silver, an investment in Kootenay is a play on a significant revaluation of the junior silver mining sector, I would argue, and feel free to disagree with me, and backed by possible high-grade drill discoveries and a 50% increase of the spot price. I would say that the future for silver assets in general and Kootenay looks particularly thrilling, I would say. So please, go ahead.
Thank you. Okay, hello everybody. So Kootenay Silver is a classic junior exploration company. We're focused in Mexico on the discovery of silver deposits, and we've been in Mexico for 15 years.